Nobody wants to get audited. Even if you're doing the right thing, there's something about getting that letter that immediately makes you feel like you've done something wrong. But a lot of audit activity I see starts with something much simpler than dishonesty. A simple data mismatch. Either something in your return doesn't line up with what the ATO already knows from your bank, from the business paying you, from your asset registrations, or even from sources that people don't realize the ATO has access to. I have been working with business owners through these situations for over a decade, and I want to talk you through the 6 triggers that are getting the most attention right now. What the ATO is actually looking at behind each one, and how to make sure your business isn't on the wrong end of it. And before you stress, most of this is fixable once you know where to look. So, for context, I know it makes sense to picture someone at the tax office reading through your return, looking at your individual expenses, and making a call on whether something looks right. But that's not how it works. It runs data matching across everything, including the things like your bank accounts, payment platforms, property registries, motor vehicle registries, share registries, health insurance records, and even your passport data for overseas travel. It also pulls income data from the businesses that pay you and from the registries those assets are recorded in. And then it compares all of that against what you've declared. If the numbers don't match, you get flagged. If your business looks different from other businesses in your industry with a similar turnover, you get flagged. If the lifestyle attached to your name doesn't line up with the income you're declaring, you get flagged. So none of that requires the ATO to think you're being dishonest. As I mentioned earlier, it just requires a mismatch in data. Now, I'm not telling you this to freak you out. I'm telling you because once you know what the ATO is looking at, you can check whether your situation lines up before they do. So let's get into what the ATO is actually looking at this financial year. I'll start with the first, using your business as a personal ATM. When you're running your own company, the lines between business money and personal money gets blurry fast. I get it. You built the thing, the cash sits in a business account you control, and at some point, whether it's paying for something personal out of the business card or pulling cash out as a loan to yourself, that line gets crossed without anyone thinking much of it. But the tax law has a specific set of rules for this called Division 7A. Simplest way to think about this is that everything a company owns belongs to the company. So if you're using company assets personally, like a car, or you're pulling money out of the company as a loan to yourself, the ATO treats that as the company giving you a benefit. And that benefit needs to be dealt with correctly, because if it isn't, the consequences are rough. The ATO taxes you on those benefits at your marginal tax rate, and you don't get a credit for the tax the company has already paid on that money. So the same money gets taxed twice. Rough. And the fix depends on the situation. But if you've been taking money out of a company as a loan, it needs to be treated as a wage, a dividend, paid back, or put onto formal loan terms with principal and interest. That's a conversation to have with your accountant, and ideally before the ATO has it with you. And the ATO has made this one of its highest priority areas for this financial year. They've expanded what they're looking at to include situations where loan repayments are being made from another loan from the same company, or where the company is guaranteeing a personal loan from a third party, like a bank. They've released 2 specific rulings on those arrangements this financial year alone, which tells you how much attention this area is getting right now. I'll give an example. I had a client in the group coaching space whose business grew extremely fast. In the first year, it was basically breaking even. And the advice at the time was just to put expenses through the business. No dramas. But then revenue took off and there was no checking with the accountant from one year to the next. They just kept operating the same way, assuming the numbers were roughly the same. And when we looked at the books, they'd drawn out $200,000 for personal use across that year, plus another $50,000 still sitting from the year before. That's $250K worth of potential Div 7A problems. To put that into more basic terms, for the company to have $250K of profit available, it would have to have earned around $333K and already paid roughly $83K in company tax on it. If we had done nothing, the client would have copped a $79K personal tax bill on top, with no credit for the $83K the company has already paid. So out of the original $333K, $162 would have gone to tax. Not great. Lucky we caught it within a time frame where we could still fix the structure, and the end result was only a 39 grand tax bill on top of the 83K the company had already paid, which is still ended up being a 40 grand savings in comparison to the 160K they would have had to have paid if we did nothing. The second trigger is centered around contractor income. If you work as a contractor in certain industries, such as building and construction, cleaning, courier, IT, and the security industry, the businesses paying you are required to report what they have paid you directly to the ATO. They do this through something called the Taxable Payments Annual Report, and it's been expanding across more industries over the last few years. And as of August 2025, paper lodgement for these reports was permanently scrapped, so everything runs through digital systems now. What this means is that the ATO doesn't need to actually investigate your income. It already has it. The businesses paying you report the amounts, including GST, and the ATO system automatically matches that against what you've declared in your tax return and your BAS. If there's a gap between what was reported as paid to you and what you declared as earned, the system picks it up and you'll likely get flagged. And this works both ways. If the business paying you didn't lodge their report or got the details wrong, that inconsistency can trigger a review on their end as well, which can then flow back to you. The ATO has said publicly that contractor income omission is one of its major compliance priorities heading into this financial year. Trigger 3 is deductions. Now, this isn't a new one and something that the ATO will always place heavy focus on. Obviously here, you shouldn't be claiming more than you're entitled to. But something a lot of business owners don't realize is that the ATO publishes its own performance benchmarks for each industry. They look at things like your cost of sales as a percentage of turnover, your total expenses relative to revenue, your net profit ratio, and they compare your numbers against other businesses in the same industry with similar turnover. If your margins are significantly lower than the benchmark or your expense ratios are significantly higher, your return gets automatically flagged. And the thing about benchmarks is you might have a perfectly legitimate reason for sitting outside of them. Maybe you've hired a head of revenue, or you've had one-off capital expenses that skewed the year. But the ATO doesn't know that from the data alone. All it sees is that your numbers look different from everyone else's, and that's enough to trigger a closer look. So if you know your numbers are going to sit outside the benchmark for your industry in a given year, make sure your accountant knows why, and make sure it's documented before lodgement, not after when you get the ATO letter. The fourth trigger on this list is non-commercial losses, and this one is specific to sole traders. If you're running a side business or a secondary activity as a sole trader at a loss, the tax system does allow you to offset those losses against other income, and there are plenty of genuine reasons to run at a loss, especially if you're in the early stages when you're investing ahead of revenue. But the ATO does have a specific set of rules called non-commercial losses that determine whether your activity actually qualifies as a business. There are 4 tests, and you need to pass at least one. The tests are, number 1, your activity has produced assessable income of at least $20,000 in the year. Number 2, you've made a profit in 3 of the last 5 years. Number 3, you're using real property worth at least $500,000 in the activity. Or number 4, you're using other assets worth at least $100,000. If you fail all 4, the ATO can quarantine those losses and they don't get offset against your other income. The ATO can also go back across every year you've claimed them and recalculate. Now, if you've already moved into a company or trust structure, this particular trigger probably doesn't apply to you. But if you're still operating as a sole trader, or you've got a side activity running alongside your main business that hasn't been structured yet, this is worth checking. The 5th trigger is around small business CGT concessions. These are the concessions that can reduce or completely eliminate the capital gains tax when you sell your business. And they're some of the most powerful tax benefits available to Australian business owners. The problem the ATO is finding is that eligibility depends on the structure and the numbers at the time of the sale, not at the time the business was set up. There are heaps of qualification criteria for these concessions, but the ones that are causing the most problems are the turnover and net asset thresholds. You either need an aggregated turnover under 2 million or net assets under 6 million across you, your affiliates, and any connected entities. The asset you're selling also needs to pass what's called the active asset test. And if you're selling shares or trust interests, there are additional conditions on top of that. The issue is that these numbers shift over time without anyone noticing. Maybe your turnover has crept past 2 million, or you've bought a property that pushes the net assets over 6 million, or another related entity has changed and now their assets are pulled into your calculation. None of that gets picked up automatically. It only becomes a problem when the sale happens and the ATO reviews the concessions after the settlement. The ATO has said that this is an area where they're consistently finding errors, including businesses failing the turnover test, failing the net asset value test, using the small business restructure rollover to access concessions they wouldn't have otherwise qualified for. The last trigger on our list is probably the most obvious one on the list, your lodgement history. The ATO assigns a risk rating based on your lodgement history across everything, including income tax returns, BAS returns, FBT returns, taxable payment annual reports. A pattern of late or missed lodgements moves you up that risk profile, and once you're sitting higher on that profile, that bar for the ATO acting on anything else in your return drops. There are also a couple of recent changes worth knowing about. From April 2025, the ATO started moving non-compliant small businesses from quarterly to monthly GST reporting. So if you've got a poor lodgement track record, the admin burden actually increases. And from July 2025, any general interest charge or shortfall interest charge from the ATO is no longer tax deductible, which means being late costs more than it used to in real terms. If any of this applies to your situation, the best thing you can do is to get someone to look at it before the ATO does. If you want our team to take a look, there's a link below to book a call. We'll walk through where you sit now and whether anything needs attention. Cheers.